let's take that in two parts, Professor. The idea that he says, quote, it feels exactly like 1999. Do you agree?
No, I don't agree. I mean, and Tom Lee was talking about forward PE ratio.
Hello, everyone. This is BTC Insight, and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
Tom Lee agrees with Siegel on one key point. Momentum is real, and it's powerful. When asked whether investors should lean into this market, even if it feels like 1999, Lee's answer is clear. Yes. He points out that momentum has historically been one of the strongest predictors of near-term returns. When markets start to run, they often run much farther than skeptics expect. Lee acknowledges the skepticism out there, the warnings about bubbles, overvaluation, or slowing growth. But he believes the momentum from AI and strong corporate profits will continue to carry stocks higher into year-end.
Markets are trying to balance a few things because we are navigating a little blind because of the government shutdown. But we also know that the real powerful driver of the equity market and the economy has been AI, which is not affected by this slowdown. So I think stocks are in this sort of zigzag pattern, but given we're in that seasonal period from October to year end, and we think the S&P can get to at least 7,000, it has been, and we've seen it this week, these pullbacks get bought. So we could be weak today, and I think we could rally tomorrow. And in general, I'd still be bullish into year end.
Are we whistling past the graveyard, Tom, on anything that could be concerning to you? I see a story right in front of me from Axios mentioning a Moody's analysis. 22 states are in recession or close to it. There was that Carlisle independent survey the other day showing the labor market is much worse than expected. Gold's been going up. Some suggest that's de-risking from the U.S. AI bubble. You mentioned the shutdown. Are we complacent towards any significant risks that we might be missing?
Well, I do think markets are less skeptical than they were in April and even in August and September, and we can see this in both positioning and AAII. So I think it is fair to say that the markets have priced in more good news. So like the things you flagged can be worrisome. But what I'd point out is that I think the AI story is actually strengthening, Scott. From our conversations with both companies and investors, it actually seems like the payback for AI, whether it's applications or services or companies' actual ROI, actually has improved in the last quarter or so. So I think that's what's helping actually create demand for spending. So I think we may be underestimating the sort of profit creation coming from AI, and I think that's why there's still legs to that story. But you're right. On balance, the data is mixed, and we don't really know because we don't have government data.
Yeah. You gave our producers this line that you still think it's the, quote, most hated rally. And I've asked you about this every time you've been on with me. I feel like now that's a little bit far-fetched to suggest that this is still the most hated rally. I don't find anybody who comes on, certainly not on the programs that I do, that is overly negative about anything. The prevailing view, even from those who were cautious before, are like the stock market's going higher. Now, it may end poorly way down the road, but it's going higher. So how can you suggest that it's still so hated?
Well, there's this thing where people can make like a backhanded compliment. Like they might say something positive about the market, but they're really bearish. Because when I hear people say, oh, well, this reminds me of 1999, or, they're ringing the bell on the top of AI stocks, they are maybe acknowledging that the market is strong, but then they're trying to mark the end of that rally. And I think, for me, who was an analyst in the 90s, people forget that Cisco in September 98 was almost a 60 PE when the Fed made its first cut in 9 months, and then its PE went to 200. NVIDIA is that stock today, and it's trading at around 27 times forward earnings. I mean, it's got a lower PE than Walmart and Costco, which are like 35 to almost 50 times. So I just think a lot of good news has been accepted by markets, but I don't think it's necessarily priced into markets.
One of the most striking parts of the discussion comes when Tom Lee talks about AI's profitability. He says the story isn't hype, it's reality. In the last quarter alone, Lee argues that the return on investment from AI spending, whether in software, automation, or chip infrastructure, has actually improved, not declined. That means AI is already paying off in real economic terms. Firms are generating tangible productivity gains, and investors are recognizing that this wave could be as transformative as the internet boom 2 decades ago.
Let's take that in 2 parts, Professor. The idea that he says, quote, it feels exactly like 1999. Do you agree?
No, I don't agree. I mean, and Tom Lee was talking about forward PE ratios. Forward PE ratios on the S&P, including Mag 7, are about 23. If you exclude the Mag 7, you're down to about 19 and a half. Back then at the peak in 2000, they were 30 going forward. The interest rates were much higher. In fact, back then you could buy 10-year TIPS, Treasury inflation protected securities, get over 4%. Today you get 1.7%. I mean, the alternatives are not anywhere near as good. No, I mean, some people say we're like 1997, which it was in December of 97 that Alan Greenspan talked about irrational exuberance. And then the market kept on soaring in 98, 99, and it did not peak until it reached crazy levels in 2000, and we are not at those levels.
The second part, of course, of Paul's point, and maybe the most salient one to my next question in our conversation is, yeah, it feels exactly like 99, but I'm paraphrasing, of course. I'm no dummy. I mean, you saw what happened from October of 99 until the spring of 2000, so why wouldn't you be positioned for a much higher stock market from here? Is that how you see it as well? Lean into this market because we're going to have a big upside from here?
Absolutely. I mean, the momentum is a very powerful factor, and the momentum is there. I do want people to understand, and it's been said before, but I think it bears listening to. Wall Street and Main Street are not the same. We were talking about how strong is the economy, should the Fed cut. I think the gap between Main Street and Wall Street is getting greater and greater. You have AI pushing, a group of stocks that is 25 to 30%. The AI hires, employs about 1% or 1.5% of the U.S. workforce. And all the other companies that aren't really doing very much are employing the other 90%. So, I mean, we have a big gap, I think, between these two. And AI can continue to soar. An indexed investor can continue to do well, even though the economy, I think, is facing some challenges. First of all, government shutdown, I don't want it to last much longer. And I still think we have a question of how those tariffs might affect Q4 holiday sales coming up, how much price increases might deter individuals. I think it's a mix between, government shutdown, negative sentiment, and we are going to get sentiment tomorrow. That's not a government number at the University of Michigan. So I say that we have to be cognizant of the fact that economy, stock market, yeah, there's a big link, but there's also a gap.
Well, I mean, this was what I was discussing with Stephanie Link, who made the point earlier on the program, whether you heard it or not, I'm not sure, that the economy is still strong, and so is the consumer. So we should be focusing more on that. There aren't as many concerns as some would like you to believe. It sounds like you disagree with that.
Well, no, we have strong investment. Strong AI investment. I don't think we're going to get the 3.8 on GDP. I think it's going to be in the mid-twos, but a lot of that's investment. And we also know that the consumption of the high end, the better off individuals, because their stock market is doing great, their bitcoins are doing great, property values are still up, their spending, the spending is pretty lackluster on the bottom half. So, when you say strength of consumer spending, you have to talk about which consumer are you talking about.
So where does that leave us? Professor Siegel reminds us that the macro picture today is vastly different from the late 1990s. Lower real rates, lower valuations, and a stronger technological foundation. Tom Lee emphasizes momentum, AI-driven profits, and investor psychology as key tailwinds that could keep pushing stocks higher into year-end. But both men agree on one thing. This is not a market to ignore.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.